Hey everyone, this is Kirk here again at OptionAlpha.com. Welcome back to the video trading recap. Had a ton of snow here in DC, and where I live just outside DC, we had about 16 inches today. So I've been pretty busy going back and forth between trading and trying to shovel, and it's been a nightmare out there. So hopefully you guys are staying safe. I know I've got a lot of people down south that had a lot of extreme weather with the ice and the snow. So again, hopefully you guys are staying safe and staying indoors. So tonight, for the video alert that we do, going over the trades that we had both opening and closing, as we always do here at OptionAlpha.com, I wanted to go over two trades that we made today. One is a pairs trade, the Amazon trade, where we rolled down our call side trade and turned our iron condor in Amazon into now a butterfly as we near February expiration. And then I also want to go over the Microsoft trade that we closed out here today for February, as a February put spread that we bought back today to profit. And I want to start with this Microsoft trade because it's really going to drive home the point, as I show you guys the charts here, on why with our strategy and our system, we do not use stop losses in our trading. I hate stop losses for risk-defined trades. That's a little bit different. You have to be a little bit careful with the undefined risk trades, so your naked puts, your naked calls, strangles, stuff like that. But with defined risk trades, the only risk management you need to do is trade a small enough position that if it were to go against you and if it were to be a max loss, it wouldn't kill your account. So what is that? That's usually anywhere between 1 and 3% is usually what that is, the total maximum risk per trade. And we have a pretty good in-depth post about that on the blog that you guys can check out that talks about how do you find out how many contracts to trade for your risk size. So check that out on the blog. But today I want to go over the Microsoft trade. It was a closing trade of the 36.35 put spread. We bought it back here today for 4 cents, made $18 in profit per spread. So again, we bought back 5 spreads, made $18 in profit per spread. A pretty good trade overall for how many contracts we traded. But what's more impressive really is why we held on to this position so long. So I have a chart up here of Microsoft. Now, as crazy as it sounds, we actually entered this trade on January 2nd. So it was one of the first trades we entered for 2014, which is right here. And that's when we entered the trade. And now remember, our strikes are at 36. Our first short strike is at 36, and our long strike is at 35. Now, had we had a stop loss, a quote-unquote stop loss that a lot of people talk about in this industry, as soon as the market went down and blew through both of our price points, we were actually looking at close to a max loss if we had closed out that trade at that point. Now, if you had a stop loss, you probably would have triggered that stop loss and closed the trade out, and just like that, it would have been a losing trade. But remember, our whole system is based on probabilities, not the probability that Microsoft would make it all the way, or that it would trade above this level by expiration, but that it would go all the way through here and that you'd have an opportunity to take profits. So by making this trade, and when we originally made this trade, we were trading with about 70% chance of success. You have to leave the trade on and let it work all the way through expiration, if need be, until it shows a profit. Now, Microsoft obviously had some difficult times. Now remember, our short strike is here at 36, so that's really the line in the sand that we're looking at. And even after it bounced out of that region really quickly at the end of January, it had a real tough time kind of breaking past this 36.5, 36 barrier until just a couple days. But again, had we closed out this trade early and closed it out using a stop loss, we would have lost money on this trade. Now, is this going to happen all the time? Absolutely not. I know people are going to say, Kirk, that doesn't happen all the time. And you're right, it doesn't happen all the time like this. But this is a prime example of letting the market work itself out, letting the probabilities of your trade work themselves out over time. And if you trade small enough and you let the probabilities work themselves out over time, you get instances like this where what would have been a max loss trade turns around and becomes a nice big fat winning trade. So hopefully that's just a really good lesson in understanding why we hold our positions until we show a profit. All right, so the trade that we had today that was a combo was in Amazon. So Amazon continued to trade lower for most of the day, and we actually rolled down our call side of the iron condor. So we have an iron condor in Amazon originally today, closed out the 370, 375 call spread, bought that back for a $34 debit, which took in a nice $26 profit, woohoo, on just one contract. But then we went back around and sold for a higher credit, a closer call spread. We moved all the way down to the 360, 365 call spread. Now here's what our Amazon position looks like all together. And I'll go to the actual Analyze tab so you guys can take a look at this here. This is what Amazon looks like right now. We have the 360, 355 put spread, and then we have the 360, 365 call spread. So now we have a big, very narrow butterfly in Amazon. All the while, we've kept our position size exactly the same with all of our rolls, so we're only rolling one contract spread at a time, and we're keeping the width of the strikes the same on both sides. And what that's allowed us to do is continue to reduce and cut this overall loss down as Amazon has moved throughout the month with this iron condor. And we're going to continue to do that, even if it just makes really wild moves in the next couple of days. Now, thankfully, Amazon's moved back inside of our strikes, and so now it's actually looking like if it stays kind of right in this range, we actually have an opportunity to make a small profit on this trade if Amazon closes and trades right at 360. Now, I don't think that'll happen, but at least we have that opportunity still left on the table, and all the while, we've reduced our overall risk on this whole position, taking in profit all the way. So again, that's a good look at why we continue to adjust trades that we have. We are very diligent on adjusting trades and continuing to take credit as you adjust. There's no point in adjusting a trade if you're going to take a debit. You might as well close out the trade and reestablish your strikes in the new month. Just kind of wipe it off the map. But if you keep taking in credit and keep your trade number of contracts the same and the width of the strikes the same, you keep reducing your overall risk in the position by adding that credit. So again, hopefully this has been a really, really helpful video. Everyone, please stay safe out there in the wild weather, and we'll get back to you guys tomorrow with some new trades. As always, please ask your comments and questions right below in the comment section. I'll get back to all of those tonight and tomorrow. Happy trading.